Business planning relies on the mathematical projection of historical data. To forecast is to move from a known baseline of past events into a calculated map of future probabilities. Every operational move a company makes, from staffing factories to managing supply chains, hinges on these projections. However, because analysts are charting events that have yet to occur, every model contains an inherent degree of error. This chart shows how analysts navigate that error. Instead of a single destined point, the model creates an expanding cone of uncertainty, mapping a range of calculated possibilities across the timeline. The connected dots on the left represent the known baseline. The stability of that past data directly dictates both the trajectory and the initial width of the red and orange probability bands, stretching out to the right. Because random variance exists in every live market, the goal is not to eliminate this cone, but to systematically narrow the spread of the probability bands. Narrowing that uncertainty requires three distinct operations: matching methodology to the product's lifespan, stripping noise from the signal, and quantifying the misses. Before a single equation is run, an analyst must determine exactly where a product sits in its life cycle. That maturity level dictates the entire forecasting model. This graph shows the standard product life cycle. If a company is launching a highly novel technology, like a holographic television, they are operating at the very beginning of the curve, known as the introduction phase. Because the product is a new invention, zero historical sales data exists. Analysts must rely on qualitative forecasting methods. They use tools like the Delphi method, an iterative surveying technique where a panel of experts pool their knowledge to estimate future demand based on experience. Contrast that with a standard LED television. It has moved past its growth period and reached the maturity phase at the peak of the curve, where manufacturing lines and consumer demand have stabilized. Here, subjective intuition is discarded. Mature products demand quantitative time series models. Analysts use years of hard historical data to generate precise mathematical projections. Applying a strict time series algorithm to a brand new invention, or relying on executive guesswork for a mature product line, results in severe miscalculations in inventory and capital allocation. When dealing with those mature, established products, quantitative time series analysis is the standard tool. It assumes that the forces which influenced past data will continue to dictate the future. This graph shows a raw, multi-year sales record. It looks chaotic, but that single erratic line is actually a mathematical composite of four distinct underlying forces hiding within the data. If we pull the data apart, the first force we isolate is the trend component. This smooth, continuous line tracks the macro-level trajectory driven by long-term shifts in population, culture, or technology. The second force is seasonality. This tight, repeating wave isolates predictable fluctuations that occur within a single year, driven by specific weather patterns or recurring cultural customs. Next is the cyclical force. Unlike seasonal bumps, these wider sweeps span multiple years, mapping out the broader macroeconomic expansions and contractions of the business cycle. What remains is random variation. This jagged signature represents the irreducible noise of unforeseen, short-duration events that will never repeat in the exact same way. Time series forecasting functions as a signal extraction problem. Analysts isolate and strip away random noise to project the underlying structural patterns, the trend, the seasons, and the cycles, forward. To begin calculating those projections, analysts start with the absolute baseline, the naive approach. This diagram illustrates its core premise, the assumption that the last period's performance will repeat in the next. If actual sales in May were 48 units, the forecast for June is 48 units. This model operates on an assumption of absolute historical stability. In live markets, random variance always injects friction, meaning the actual June sales will inevitably deviate from that 48. Since every model, from this simple baseline to heavily weighted algorithms, eventually splits from reality, generating the forecast is only the first half of the process. The second half is diagnosing the exact severity of the deviation. Because qualitative intuition is subjective and quantitative models mathematically drift, rigorous error measurement is mandatory. This table shows a sample dataset for wireless speakers. By subtracting the forecast sales from the actual sales, analysts isolate the absolute value of the error, revealing the raw numerical gap between expectation and reality for each period. To interpret those gaps, analysts apply three specific mathematical formulas. The first is mean absolute deviation, or MAD. MAD takes the sum of those absolute errors and divides by the number of periods, yielding a straightforward average of how many raw units the forecast missed by. The second metric is mean squared error, or MSE. Here, the raw forecast errors are squared before they are averaged. Squaring the error exponentially penalizes outliers. A small miss stays relatively small, but a large miss grows in mathematical weight to dominate the metric. This makes MSE useful for managing delicate supply chains, where a single large forecasting failure would be catastrophic. The third metric is mean absolute percent error, or MAPE. Unlike the previous formulas, MAPE divides the absolute error by the actual demand, scaling the raw unit numbers into a flat percentage. That scaling allows an analyst to look at a 3% error rate on a line of high-volume speakers and instantly compare it to a 3% error rate on low-volume, high-end televisions, regardless of the drastic difference in raw units sold. These equations serve different functions. Analysts choose between MAD, MSE, or MAPE to penalize specific types of variance and manage the unique risks of their operations. This chart represents the systematic, mathematical management of the unknown. By isolating structural trends from random noise and quantifying mathematical misses, businesses establish the operational stability required to navigate an unpredictable future.